Welcome to Deal Dialogue.
Hello and welcome to Deal Dialogue, a discussion on all things M&A and financing. I'm Rob Hickey with RBC Mid-Market M&A. In this segment, we are going to discuss the first of a number of recent innovations changing the deal-making industry for the better. Now, some innovations are of a technological nature, and we'll talk about those in the future. Others involve new financial products and services that seek to create efficiencies, lower risk, or costs. One such offering that we will discuss today is representation and warranty, or rep and warranty insurance. Joining us today, along with our production engineer, Tarek Chami, is Sean Flynn, a vice president with BFL Canada. Sean, welcome to the podcast.
Thank you, Rob. Thank you, Tarek. Awesome to be here.
Before we dive into this topic, Sean, can you give us a little bit of your background?
Yeah, certainly. I was with Scotiabank corporate banking for about 5.5 years in the telecom media technology group as a lender. I then pivoted into commercial lending and did that for about 1.5 years and really fell in love with supporting private businesses and getting behind entrepreneurs. And through kind of referral networks, I learned about this product, rep and warranty insurance, and saw an opportunity to come over to a space that was growing, a little bit more exposure to private equity, and jumped over about 14 months ago to BFL Canada.
Great. Tell us about BFL Canada.
BFL Canada is one of Canada's largest insurance brokerage, risk management, and employee benefits consulting firms. Have over 750 employees, 18 offices, so we truly cover Canada from coast to coast. We have global capabilities. Sometimes people think with our name we might not reach beyond the country, but we are a founding partner in Locked in Global, giving us access to 130 countries. And lastly, I would say we have a very entrepreneurial spirit and DNA, and we really love supporting Canadian businesses.
Great. So with that background, I think we'll give a little precursor here about rep and warranty insurance. So M&A deals involve many documents, and ultimately the transaction is documented in an agreement of purchase and sale, which is a legal document between the buyer and seller. This sometimes daunting and lengthy document spells out the legal terms of the transaction and responsibilities of the buyer and seller. Included in those responsibilities are what are called representations and warranties, or reps and warranties. What I can tell you from personal experience is that this phase of a transaction historically was fraught with risk and angst on both sides and typically could derail a transaction. Up until very recently, this process did not change, but there has been innovation in the industry with the introduction of rep and warranty insurance. Sean, can you, just for the sake of folks that are listening, describe reps and warranties generally before we get into the evolution of the product?
Yeah, with that one, Rob, I'd like to kind of give people an anecdote on buyer and seller have agreed at this stage on a purchase price. But like he said, there's some angst there. The buyer is completing diligence and is getting more comfortable with the target. But what happens after close? What happens if certain of these certain contracts don't play out, or certain pieces about the financial employment? So many different buckets of this business. And then right there, you're going to be looking for a good disclosure with that seller to kind of tell us everything about this business. The rep and warranty piece of the purchase and sale agreement, and that's that vendor saying, I'm asserting on this date when we close this transaction that everything about this business is true. Right. All these things about these financial statements, my fundamental ownership of shares, you can go through all those different reps, right, but everything about this business is true and accurate at this date.
Okay. And so then talk to us. I mean, obviously that is a process of negotiation in terms of what is true and what amount of liability I'm willing to accept if there's a breach of those. So along comes rep and warranty insurance as a way to mitigate some of the challenges in the process. Can you talk a little bit about the evolution of rep and warranty insurance, and then maybe get into what it specifically is?
Yeah, sure. So on the origins of the product, it's been around for 20 plus years, and it was originally a way for private equity to accelerate sales proceeds of a portfolio company, and I think probably end of fund kind of portfolio company.
Right.
Where we want to wind this thing up, but we now have to put money in an escrow account for 18, 24 months. there's got to be a better way to do this. And along came the solution to transfer that kind of large escrow holdback to an insurance company's balance sheet. But it was expensive. There was coverage gaps. The underwriting process wasn't seamless. And only in the last probably 5-7 years in the North American context has pricing come down, coverage gaps narrowed, rep and warranty insurance companies hiring experienced attorneys and counsel that understand the deal velocity of transactions. So with that becomes something that is considered more and more. I think just essentially it's, and I said it off the top, it's reducing the need for a large escrow holdback.
Right.
So like you said with the rep and warranty, these are things about this company, and here's kind of the indemnification. If it's a 20% holdback of a $100 million deal, that's a lot of money tied up.
Right.
Could there be a more effective way to transfer that to someone else, and I can kind of get off risk if I'm the vendor? And that's kind of the origins of the product.
So historically, in the absence of rep and warranty insurance, the two parties would be negotiating over the reps and warranties. There'd be a large amount potentially placed in escrow in the event there was a breach. How does the introduction of rep and warranty insurance change that?
Yeah, I think it's both sides. And let's say, on the sell side, you have the investment banker and counsel, and on the buy side, you have counsel as well. And I think it's just lowered the temperature in the negotiation of those rep and warranties. People know from the onset, this is an insured deal, and maybe we don't have to fight to win risk allocation points. It's lowering the temperature in the room. It's focusing on the other things you want to get on, because we're getting insurance here, and we can look to maximize execution of this deal.
And who is using rep and warranty insurance?
So as we said, the genesis of the product was kind of a private equity backed idea. So in the private equity world in the U.S., depending on who you speak with, but probably 75% of U.S. PE deals are insured. In the Canadian context, Canadian private equity firms, probably 30 to 40%, and that's increasing year over year. But it runs the gamut, and I've listened to your prior deal dialogues when you went over the classification of buyers. All of those buyers are using it. Corporate strategics,
Interesting. Yeah.
pension plans, family office, search funds.
I'm glad one person's listening.
There we go. Well, and when Jeff spoke of that too, international buyers who are coming in, and he was talking about how they might have access to cheaper financing. They're also bringing in rep and warranty insurance as a sweetener. And that's also driven by the fact that in their jurisdiction, whether in the U.S. or in the European theater, this is just a product that is used more often.
Okay. At what point in the process is it appropriate to start exploring the utilization of rep and warranty insurance?
We like to say the earlier the better.
Right.
Just take, for example, on the buy side, if we're talking to the buyer or their counsel or someone else and another deal constituent, the earlier the better. We can scope out high-level pricing.
Right.
What kind of deal is it? Where is that target? What are going to be let's make sure your diligence focuses on this, because that's what the insurer will want to see, and just kind of help understand the deal thesis, valuation, so we can build a narrative. But the earlier the better. But the way we come at deals, sometimes we're brought in from the sell side, whether it's the investment bank or counsel or the seller, and say, I really like the idea of having a cleaner close. Can I get quotes for rep and warranty insurance? Right. And then we kind of work with the seller and go from there. So
you talked about buy side and sell side. Are there two different types of rep and warranty insurance?
Yeah.
And what are they?
There's buy side insurance, which is a first party insurance policy.
Okay.
And there is sell side policies, but the overwhelming majority are buy side.
Okay.
Close to 100%. Quite a few carriers don't like to underwrite sell side policies, but they can be done. And we have done one at BFL, but it's essentially it's insuring the seller's indemnification, but it's a third-party policy, so it needs to be triggered by the buyer taking a claim to the seller. A lot of times when we come in from the sell side, we end up flipping over to the buyer, so it ends up being a buy-side policy, and you're kind of going to the other side. So overwhelmingly buy-side policies.
in the legal agreement, there's typically a fairly lengthy list of representations and warranties that are required. What's covered by the insurance typically?
Yeah, so something I should have spoke of earlier, your coverage will be, and another benefit on the buyer side is you're extending out the survival of your reps beyond what you might have been able to get in the purchase and sale agreement. But you're getting 3 years of general rep coverage, 6 years of fundamental, 6 years of tax, and if it's a share purchase agreement, you have a pre-closed tax indemnity. That's kind of your standard coverage.
Okay. And that begs the question, what isn't typically covered by insurance?
Yeah. Your standard exclusions for rep and warranty insurance, and it's just kind of understanding what the product is. It's covering deal unknowns.
Right.
So we're putting this purchase and sale agreement in place. Like when we talked about in the beginning, the buyer is not really sure they've got everything. What happens if an unknown comes out of the woodwork? That's what the insurance is covering. So if there's actual knowledge of a breach, that should be scheduled. That's not going to be covered.
Right.
Net operating losses, transfer pricing if there's subsidiaries in other jurisdictions, because the due diligence is typically not there, and also any forward-looking or projections. And what that's getting at is it's not going to collect the future collectability of accounts receivable will not be covered. This is a policy that is covering the diligence that was done to December 3rd, 2019, looking backward. So it's just understanding what the insurance is and what it is not.
Okay.
You're listening to Deal Dialogue.
A deal gets to the point where people are discussing rep and warranty insurance. They reach out to you. What is your process?
Yeah, so you could almost split the process into the quotation phase and the underwriting phase. But when people reach out, right away it's, let's sign an NDA and let's get into confidentiality. We really just want to understand what excites this buyer about this target. Tell us about how you came across this deal, how you look at it, and really as far as information to go get quotes, the conversation is going to change. They could be an experienced user of the product or it could be the first time. So we'll take the conversation from there. But what is needed to get quotes is a SIM, also known as a confidential information memorandum.
Covered in segment 2.
There we go. Or a management presentation. And sometimes we put these things together too, because it just might be a process that's not done. But anything that gives the insurer a flavor for what is this business, what is the sector, what are the risks inherent in that. Some financial statements, there could be an LOI, a letter of intent, there could be a purchase agreement in draft form. And with that information set, we can send that off to the insurers that we work with.
So you work with a bunch of carriers that provide the coverage. So you're a value-added provider of the product.
Exactly, and we can access multiple markets, so we get a nice cross-section of how everyone looks at that deal, from a pricing, from a coverage, from an execution capability, and just general appetite to underwrite that deal. So we can get that information package, that submission to markets, and in 2 to 3 days we can take that, collate that, put that in a report, and sit down with our client and their counsel and advisors and kind of just talk about, is this a good fit? Do you want to maybe explore this with the other side? Put this into your process. So that's the quotation stage. And I might be getting ahead of you on your next question, but then it's kind of underwriting. So it's we've taken this to however many markets. Sometimes it's a very narrow subset. Sometimes it's a little wider. Maybe depends on deal size or if the deal's hairy. And okay, we talked to our client, Sean, we want to go forward with this carrier. So how does the underwriting process get triggered? It's really understanding the deal timeline. But what we do to trigger the underwriting process is sign a term sheet. So this is the insured agreeing to pay the third-party cost that the insurer will incur as part of the underwriting process. And it's also just understanding where are you in the due diligence process. Are your due diligence materials nearly there? What's the state of the legal documents? Are the disclosure schedules in decent form? Where's the purchase agreement? And when all those things are kind of in good draft form or near ready, we can kind of set up an underwriting call, which is about an hour and a half, 2-hour call where we methodically go through the deal and just allow the insurer and their counsel to kind of just get a good sense of how the buyer has conducted really thorough due diligence and has independently verified all the reps that are in that purchase and sale agreement.
Was the question that you were anticipating I was going to ask what the cost is?
No, but I guess I knew it was coming. And the cost varies, and it depends on, it's kind of a two-pronged answer, but it depends on the insurance limit that's purchased. So if we take a $100 million enterprise value or purchase price deal, and you're looking to replace a 20% indemnity cap,
Right.
so a $20 million limit.
Right. So the essence of that is that the seller is basically liable for up to $20 million in the event of a breach of their rep and warranties.
Correct.
Okay.
And in that purchase agreement, that's probably your general reps,
Right.
and they might have,
Right.
you know,
Okay.
fundamental reps might be the full 100% of
Correct.
the purchase price. So exactly. And what we're doing there is all the pricing is rate online. So it's your premium divided into your insurance limit. And I would say probably in the market right now, that rate online is 2.5% to 3% of the
Okay.
insurance limit purchase. So for that $20 million insurance limit, it's take a midpoint, $275,000
Right.
is the premium, which
Right.
can be split by buyer and seller.
I was going to ask, who's typically, in your experience, paying the premium?
It's a whole mix.
And it's a one-time premium, not an annual premium.
Exactly. It's a one-time premium that provides that 3-year general,
Right.
6-year fundamental tax coverage. And it depends on the dynamics of the deal.
Right.
Sometimes both sides say, hey, we get a lot of benefits here. Other times the seller didn't want to maybe pursue a personal guarantee,
Right.
needs to distribute their funds to their LP investors, or it might be a hotly contested auction and everyone kind of knew that these costs were always going
Sure.
to be borne by the buyer. So that's your premium,
Right.
the $275,000 in this case. And there's also an underwriting fee, as I alluded to earlier. And this is a fixed fee up front, and this is the cost for that carrier to hire third-party vetting counsel to help them through the underwriting process. That averages probably $40,000 in the Canadian
Okay.
market. So those are your two cost components for an all-in cost. And the only other thing, just to make sure we touch on it, not quite a cost component, but the retention, which is the self-insurance or kind of the aggregate deductible. So in this $100 million example, the retention is typically 1%,
Okay.
so $1 million, and it drops down to 0.5% after a year, just based on that's when a lot of claims seem to happen in a 1-year period.
So what would have been potentially a fairly significant escrow? And again, we're not, segment one was working capital. We're not talking about working capital escrows. We're talking about an escrow that's set aside for, resolving any breaches of reps and warranties. The insurance now means we don't need that significant escrow, but there's still a certain amount, the retention amount,
Exactly.
which you just defined.
Yeah, so if you're the vendor in this hypothetical
Right.
sale purchase we just set up, you've just taken that substantial $20 million and you've
Right.
reduced it really to $500,000.
Amazing.
Your half of,
Right.
of the retention.
Right.
Yeah, and there might be also an escrow amount for the working capital, and for any special indemnities, when we go back to our exclusions, there could be some deal-specific exclusions that due diligence just uncovered known things that are
Right.
kicked out of coverage. So you're right. As a vendor, I could have that $20 million sitting in an escrow account not earning very much, or I could have freed that up,
Right.
kind of time value of money for the vendor.
I mean, historically, just the back and forth over the escrow, the amount of it, and the cap, and then the amount of escrow required were significant. And then my experience has been that this product has really taken a lot of that out of the transaction, and on a basis that I think people more and more understand on both sides. So it's, from my perspective, been a great innovation. What's talking about, we're mid-market team, what would be the minimum deal size that would make sense to have a product like this where, obviously there's limits for everything.
Yeah, and what really excites us is how the market, and I think at BFL we've worked really hard to build out that addressable market where we think it is a great M&A tool for middle market, lower middle market deals. Minimum transaction size. Long time ago, we say it was a big number, $50 or $100 million. Right now, I'd probably say 15 or 20 million.
15 or 20 million
is where it makes economic sense
Yeah.
for the minimum premiums.
Okay.
And that minimum premiums, you could probably budget 150,000.
Right.
We could probably edge that down a little bit, depending on the deal, depending on competitive forces and who likes it. But as long as both sides understand the cost and there's a motivation to put it in place, and the diligence is there, disclosure practices are there, we think it could be a real good fit.
Are there any other products? I know we're here to talk about rep and warranty insurance, but are there any other products that should be thought about that BFL would be able to facilitate?
Yeah, in the transactional risk insurance space, when you think of rep and warranty insurance, and we talked about buy side versus sell side policies, but also when diligence uncovers a known or perceived issue, so
Right.
perhaps in tax diligence. So something's popped up, the rep and warranty coverage won't be there for it.
Right.
And now both sides, you're back to that traditional, who's going to take that risk? Is there going to be an escrow account for that, or is the buyer going to take that risk or reduce their purchase price? And you might have a standstill.
Right.
There could be an opportunity for tax indemnity insurance, and we've put these policies in place, which basically the high-level definition would be a tax authority taking an adverse position of the tax treatment of the company or of a pre-close reorg. And this kind of gating item can maybe be underwritten in an insurance policy, can be put in place to kind of alleviate those concerns. There's contingent, seldom used, I should say, contingent liability insurance, and this could be any number of things: IP ownership, contractual dispute. It's a known or perceived issue. It's a gating item, and it could be a candidate for contingent liability insurance, but highly bespoke, very different underwriting process than rep and warranty insurance, and we like to look at them as a low probability, high severity event. And just like rep and warranty insurance, let's get in there ahead of time. Let's discuss how it's come up and how you are comfortable that it's mitigated, and let's see if there's a possible solution for it. The only other thing I'd say about BFL, a lot of brokers, you come in and we can support on the insurance due diligence, and there just might be some other needs to help with the go-forward insurance coverage.
Okay, well, that's great. Look, Sean, this has been a great overview on what I think is an innovation that is changing the M&A business for the better. I can tell you every deal we work on, we are thinking about this solution as a way to make the transaction just smoother and get closer to a close. Thank you for taking the time to speak to us today.
Thank you very much, Rob.
That's it for this segment of Deal Dialogue. Our guest was Sean Flynn of BFL Canada. Our production engineer, as always, is Tarek Chami, and I'm Rob Hickey. Thanks for putting us in your ear or on your device, and good luck with your deals. Deal Dialogue is a production of RBC Mid-Market M&A.